Welcome to the deep dive. Today, we're really getting into something crucial for any investor, understanding stock valuation. How do you figure out if a stock's price actually makes sense?
Exactly. We're trying to cut through the day-to-day market chatter.
Right.
We want to dive into the core principles, figure out what a stock might really be worth based on its fundamentals, its intrinsic value.
And for this deep dive, we're looking at insights from the Streetsmart Guide to Valuing a Stock. It's from 2004, but the core ideas, still very relevant.
Oh, absolutely. The fundamentals don't change that much.
So our mission here is really to equip you, the listener, with a solid foundation, moving beyond just watching prices bounce around.
Okay, so where does the book start? It focuses on three fundamental drivers for investment returns.
Yeah, it lays them out pretty clearly. The amount you get back, when you get it back, the timing, and critically managing risk.
And it's amazing how easily people forget these, especially when markets get, well, a bit crazy.
Like the historical examples the book brings up.
Precisely. Think about the Dutch tulip bulb mania back in the 1600s. People were paying house prices for, a single flower bulb.
Wild. Completely detached from reality.
Totally. It shows how speculation can just inflate prices way beyond any intrinsic worth.
And it's not just ancient history, is it? The book points to the run-up before the Great Depression, too.
Yeah, the late 1920s, similar pattern, soaring stock prices, lots of borrowing, speculation. Then the crash. It's a stark reminder about ignoring underlying value.
Which brings us to that key distinction the book makes. Price versus value.
Crucial. Price is just what you pay right now. It's driven by supply, demand, sentiment, all sorts of things.
But value.
Value is different.
Value is what the company, the underlying business, is actually worth. Its ability to generate cash, its assets, its future prospects. That's the target we're aiming for with valuation.
Okay, so how do we estimate that value? The guide really focuses on one main method, right?
Yes, discounted cash flow, or DCF. The book positions it as really a primary tool used by professionals and sophisticated investors alike. And the basic idea is,
The core concept is actually pretty elegant. You basically estimate all the cash you expect a company to generate in the future,
okay,
and then you figure out what that future cash is worth today. You have to discount it back.
why discount it?
Well, two main reasons. Risk the future cash isn't guaranteed, and the time value of money. A dollar today was worth more than a dollar promised next year.
Right, because you could invest today's dollars.
Exactly. So DCF accounts for both that risk and that opportunity cost.
The book uses a simple example, that ABC utility company.
Yeah, it's a good illustration. Imagine a stable utility, makes $200 million profit every year, pays it all out. If investors need, say, a 10% return for that kind of stability,
How much is it worth?
you just divide the $200 million by that 10% required return. So $200 million, 0.10, gives you $2 billion.
Yeah.
That's the market cap the profit supports under those conditions.
But here's the kicker. The book highlights what happens if that required return changes. Maybe interest rates go up.
Yes. If investors suddenly demand 12% for ABC, that same $200 million profit now only supports about $1.67 billion. The value drops.
And if rates fall and they only require 8%.
Then the value jumps. $200 million divided by 0.08 is $2.5 billion.
So it really shows that inverse relationship, that seesaw between interest rates or required returns and stock valuation.
Absolutely. Higher rates generally mean lower valuations, all else being equal, and vice versa. It's fundamental.
Now, the ABC example is simplified. A real DCF is more involved.
Oh, definitely. You're forecasting cash flows years into the future, maybe making assumptions about growth, then choosing an appropriate discount rate. That's a big step, bringing all those future values back to the present and summing them up. It's an estimate of intrinsic value.
You mentioned the discount rate reflecting risk. Let's talk more about risk. The book spends some time defining it, right? It's not just a gut feeling.
No, definitely not. In finance, risk is about the uncertainty of getting the return you expect. How wide is the range of possible outcomes?
Like comparing a safe government bond to a volatile tech stock.
Exactly. The book contrasts low-risk things, like treasury bills, where the return is almost guaranteed, with, say, a small biotech firm where the outcome could be amazing, or, well, zero. Much higher uncertainty, therefore higher risk.
And the book introduces beta as a way to measure a specific type of risk.
Yes. Beta measures a stock's volatility relative to the overall market, typically the S&P 500 index.
So the market itself has a beta of
1, by definition. A stock with a beta of 1.0 tends to move up and down pretty much in line with the market.
And if beta is higher than 1?
More volatile, think high-growth tech stocks sometimes. They might jump more when the market's up, but also fall harder when it's down.
And less than 1?
Less volatile, like maybe some established utility companies or consumer staples, they tend to fluctuate less than the broad market.
Okay. The book also mentions the market risk premium. What's that about?
That's the extra return investors, on average, expect to get for taking on the risk of investing in the stock market as a whole compared to sticking their money in something considered risk-free, like those T-bills.
Wow.
It's the reward for taking general market risk.
And there's another risk measure mentioned, standard deviation.
Right. Standard deviation measures the dispersion or spread of potential returns around the average expected return.
Yeah.
A higher standard deviation means a wider range of possible outcomes, more volatility, more risk.
It's interesting. The book notes the long-term average annual return for large U.S. stocks has been somewhere around, what, 12%?
Yeah, historically. That gives you a sort of benchmark, and it connects to the idea of the risk-return trade-off. Generally, to get higher potential returns, you have to accept higher risk.
The book also briefly touches on mean reversion.
Yeah, the idea that over long periods, stock market returns tend to regress towards that long-term average. Periods of super high returns might be followed by lower ones, and vice versa. Doesn't always work in the short term, though.
So the core message on risk is, understand it, measure it if you can, and expect to be compensated for taking it on.
That's the gist of it, yes. No free lunch. Higher potential return usually comes with higher potential bumps in the road.
Now, moving on, the guide gets into the psychology of markets, expectations, and behavioral finance. This acknowledges that we aren't always perfectly rational robots, right?
Definitely not. The old theory, the efficient market hypothesis, kind of assumed rationality that prices always perfectly reflect all information instantly.
But reality seems messier.
Much messier. Behavioral finance brings in psychology, sociology. It recognizes that emotions like fear and greed, cognitive biases, herd behavior, they all influence investors and can push prices away from fundamental value.
The book even mentions Nobel Prize winners like Kahneman and Smith who explored this.
Yeah, their work was groundbreaking in showing how people actually make decisions under uncertainty and how markets aren't always perfectly efficient or rational. Smith's experiments were fascinating demonstrations of market bubbles forming even in controlled settings.
So how do expectations play into this? The book gives an example of a company, DEF Growth, reporting good news, but the stock price falls. How does that happen?
It's all about expectations versus reality. If DAF reports 10% earnings growth, but the market was expecting, say, 15%.
It's a disappointment.
Exactly. Even though it's positive growth, it missed the whisper number or the baked-in expectations. So investors might revise their future estimates downwards, and the stock sells off.
Wow. And the EDS example was even more dramatic.
Oh yeah, electronic data systems. They lowered their forecasts, didn't meet expectations, and bam. Stock price cratered, lost like half its value very quickly. Shows how sensitive prices are to future outlooks.
Okay, shifting gears slightly. The book also warns about how we measure returns and the impact of costs. Let's talk averages first, simple versus compound.
This is really important. A simple average can be misleading. The book uses that Martha the portfolio manager example, right?
Yeah, where she has a huge gain one year, then a big loss the next.
Right. The simple average might look okay, maybe even positive. But the compound average return, the geometric mean, shows you what your money actually did over the whole period. If you have 50% gain, then a 50% loss. Your simple average is 0, but you actually lost 25% of your money. Compound return is the true measure of investment growth.
Good point. And then there are the costs. They can really bite, can't they?
Absolutely. Brokerage commissions, mutual fund fees, expense ratios, advisory fees. They seem small, maybe 1% or 2% here and there, but compounded over years, they significantly drag down your net return. Minimizing costs is key.
Plus taxes and inflation, the silent killers.
Exactly. In a taxable account, you'll owe taxes on dividends and capital gains. And inflation erodes the purchasing power of whatever returns you do keep. That's why the book mentions things like IRAs, 401ks. Those tax advantages really help over the long run.
This all ties back to another fundamental concept the book covers, the time value of money.
The cornerstone of finance, really. A dollar today is worth more than a dollar tomorrow.
Because you can invest it and make it grow.
That's the compounding side, yes. Money earns returns over time. The book shows simple examples of how an investment grows. But the flip side is discounting.
Which we use in DCF.
Precisely. Discounting asks, what is that future dollar worth today? It brings future expected cash flows back to their present value, considering time and risk. That's how we value stocks based on their future potential.
Makes sense. The guide also stresses not putting all your eggs in one basket, talking about asset allocation and diversification.
Yeah, crucial for managing risk. Asset allocation is the big picture.
Hmm.
How much do you put in stocks versus bonds versus cash, maybe real estate or other things. It depends on your goals, time horizon, risk tolerance.
And diversification is within those categories.
Right. Within your stock bucket, for example, you don't just buy one stock. You spread it out across different companies, maybe different industries, different sizes, large cap, small cap, different styles, like growth versus value.
Why does that help?
It reduces unsystematic risk, the risk that one specific company does poorly. If one stock tanks, it doesn't sink your whole portfolio. You can't diversify away market risk, the risk that the whole market goes down, but you can significantly reduce company-specific blows.
Okay, so we've covered core concepts: risk, expectations, costs, time value, diversification. How do we actually do the valuation? What are the main approaches the book mentions?
Well, it contrasts fundamental analysis with technical analysis. Technical analysis studies price charts and trading volume, looking for patterns.
But the book focuses on fundamental analysis.
Yes, that's about digging into the company's financials, its management, its industry, the economy, trying to determine that intrinsic value we talked about.
The basic rule being,
Buy when the market price is significantly below your estimated intrinsic value, undervalued, and consider selling when it's significantly above, overvalued.
and the book brings up the capital asset pricing model, CAPM.
Right, CAPM is a widely used model to estimate the expected return on a risky asset, like a stock. It links expected return to the risk-free rate, the stock's beta, and that market risk premium we discussed earlier.
So expected return equals risk-free rate plus beta market risk premium.
That's the basic formula, yes. It helps determine the appropriate discount rate to use in a DCF analysis, because that discount rate needs to reflect both the time value of money and the specific risk of that stock, often estimated using beta via CAPM.
Got it. And a key metric the book highlights for the cash flow part of DCF is free cash flow to the firm, FCFF. Why that specific measure?
FCFF is seen as a really robust measure because it represents the cash generated by the company's operations that's available to all its capital providers, both debt holders and equity holders, after making the necessary investments to maintain and grow the business.
So it's like the total cash profit pool before financing decisions.
Kind of, yeah. It strips out some accounting distortions and focuses on the actual cash being generated for investors. The book emphasizes that a company only truly creates value if its return on investment is higher than its overall cost of capital. It's WACC, or weighted average cost of capital, and positive FCFF reflects that.
And this relates to growth and competitive advantage.
Absolutely. A company with strong competitive advantages, a great brand, unique tech, network effects, whatever might be able to earn returns above its cost of capital for a period. That's the excess return period.
And the valuation tries to capture that.
Yes, the DCF model typically forecasts cash flows during that excess return period and then adds a terminal value or residual value, which represents the company's value beyond that point, assuming more stable, competitive returns. It's why focusing on FCFF is often preferred over just earnings per share, EPS, which doesn't always reflect the cash generation or the necessary reinvestment.
Okay, this sounds complex. For someone wanting to try this, where do they even find all the numbers? Growth rates, profit margins, cost of capital, inputs.
It does take work. The book points you to company resources. Annual reports, 10Ks. Quarterly reports, 10Qs, are essential. They're on company websites in the investor relations section or on the SEC's ADGR database.
And financial website.
Yeah, places like Yahoo Finance, Google Finance, MSN Money. They compile a lot of historical data, analyst estimates, things like beta. But you need to understand what the numbers mean.
How do analysts typically estimate things like future growth or margins?
Often they start with historical averages for the company and its industry, and then adjust based on management guidance, industry trends, economic outlooks. Estimating the cost of capital involves finding the current risk-free rate, estimating the market risk premium, finding the company's beta, estimating its cost of debt. It requires several inputs.
And you have to factor in the number of shares, including options.
Definitely. The final step is usually dividing the total estimated value of the firm by the number of outstanding shares, making sure to account for potential dilution from stock options or warrants to get an intrinsic value per share.
The book briefly mentions valuing different types of companies too, right? It's not one size fits all.
No, it notes adjustments are needed.
Yeah.
For banks, interest is an operating item, not just financing. Conglomerates like Berkshire Hathaway are tricky because you might need to value distinct businesses separately.
Mm-hmm.
REITs are heavily influenced by property values and interest rates. The examples just show how different inputs drive different values.
So wrapping up, the guide brings it back to the market dynamics, price versus value again.
Right. It reiterates that short-term prices are swayed by supply and demand, news flow, sentiment. It cautions against just blindly following analyst price targets. Do your own homework.
And the danger of holding something just because the price went up, even if it's way above its fundamental value.
Yeah, being in a significantly overvalued stock is risky. Eventually, prices tend to gravitate towards intrinsic value, though it can take a long time. And while some theories suggest markets are efficient, the book nods to evidence, like value stocks sometimes outperforming growth stocks over time, suggesting maybe markets aren't perfectly efficient all the time. There can be opportunities for diligent fundamental analysis.
Okay, so if we boil down this whole deep dive, guided by the Streetsmart guide, what are the really key takeaways for our listeners?
I think it's about, first, understanding those core principles: time value, risk, cash flow. Second, doing the work to estimate a company's future prospects and risks to arrive at an intrinsic value. And third, always remembering that crucial difference between the market price you see flashing on the screen and the underlying worth of the business.
It's about developing that independent judgment, looking past the noise to see the substance. That seems to be the core message.
Exactly. It's about becoming a more informed, more discerning investor, not just chasing trends.
All right, here's something to leave you with. In a world absolutely saturated with real-time stock prices, available 24/7 on your phone, what is the enduring advantage, the real power in taking the time to understand a company's true underlying intrinsic worth? Something to think about. Thanks for joining us on this deep dive.